Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. As projected, the grain markets have been rolling over the past few days, and we'll begin here with the December corn contract. If you recall from our last discussion, we said that if the market broke 329 to anticipate a move down to about 317 and 3/4 at a minimum, with the possibility of reaching down as low as 311 and 1/4. The low so far has come in right at about 314, and what you'll notice inside of here is the market came in and touched our make or break region, which is this green horizontal area here, which was our target zone. It also happened to coincide with our natural support level, and as the market came in and touched right inside of here, we're seeing a little bit of support today, but that may make for only a 2 or 3 day bounce of sorts, depending on how strong the correction is. We are still inside of a strong downtrend, and you'll also notice here that the market has come into our timing region or our time factor zone, where over the course of the next couple of days, we could see a low come in or a change in trend where the market can either move sideways or give us a small bounce to the upside. We continue to have resistance at 329, and the market will need to get above that level if it's going to get some legs. For now, we believe that corn is probably going to continue to have weakness. The low that was made today actually came in at 314 and 3/4 so far. And you'll also notice that the market came in at one of our horizontal support levels for our natural angles. The market's been timing very well in this regard. We'll continue to watch it very closely here. With today being first notice date, we've moved on from the September contract and have instead replaced it with the March contract. I wanted to highlight a couple key objectives for us here when we look at this March contract. The market had become overbought when it reached the 90-degree level at 353. This overbought was represented here on our overbought oversold indicator. The market came in, made a very nice move to the downside right inside of our target region, which surrounds the 225-degree mark. That price threshold was 325.5. The market has come in and is testing right inside of that region here. And additionally, we have volatility-based support that has come up, and we see a bit of compression here where we have the two sets of overlap for the volatility bands. We can see the area here is overlapping, and that overlap can make for a bit of support when we look at the market there. It's going to be important as we trace this market out. If we fail at this 325 half number, then we can see continued weakness. And so this is the area we're going to be watching in particular over the course of the next couple days. 2 levels below the point of control for this contract is at 345 and 3/4. Upon breaking 345 and 3/4, which sits right about at this level here, this is where the market found its true weakness, and from there it really descended for a very nice move to the downside. Again, we're finding support right up against a key horizontal level here, and we'll continue to monitor how the market moves from this point forward. As far as soybean is concerned, much of what we have discussed has come to fruition in a very timely fashion. We talked about the Fibonacci series numbers coming in and playing an important role in determining a potential top coming in for this soybean contract. 8, 14, and 21, with the Fibonacci series numbers being 8, 13, and 21 as opposed to the 20 days that we see here. Once that occurred, the market then had a very nice sell-off to the downside, and that top coincided with being overbought. Now, part of what we're looking at today is we can see that over the course of the previous 14 days on the move up, the market moved 77 points. On the way back down on the other side, the market has actually covered the same amount of ground on the way down, but has done it in fewer trading days. What this tells us is that we're looking at an overbalanced situation where the market is actually struggling to go up and is finding it very easy to go back down. This tells us that this market has more room to go to the downside, and we're looking at a possible minimum price objective of about 900 or so. So we want to be very careful with this soybean contract. From this perspective, we can see very nicely how the market came in, and that red 1-by-1 angle that came in was very good support. The market bounced from there, consolidated across the top, and then rolled over, and now we see the move to the downside. Again, we talked about maybe 900 being a minimum price objective for it to hit. The point of control is at 960.5. One standard deviation below that is at 870. So somewhere in the neighborhood of 870 to 900 over the course of the next couple weeks is probably very realistic for this contract. The Jan bean contract is having trouble of its own. 14 days up, 7 days down. Over the course of the last 7 trading days, it's covered more ground than it was able to cover on the 14 days on the way up. So as we look at this market, we see continued weakness on the horizon. We do have volatility-based support coming in from the downside. And so we have our minimum target of 925 coming in right inside of our target band or our target region. It also happens to coincide with our 180-degree mark. But here we can see the volatility-based support band at about 873.5. And if that band makes a shift to the upside, then we're looking at potential support at about 918 or so. So the real key operating number that I like for this particular January contract is 918. Failure below 918 should send us down to about 873.5. But for now, the near-term support that we're looking at for a potential bounce will be 925 and 918. As August is rolling to a close, we have another potential time factor turning point coming up. That time factor threshold is between September 12 and September 13. So if this market's actually able to continue downward into this date, we would look to have a nice little bounce from here. If the market actually bounces beforehand and advances up into September 12th or 13th, then we could see a reversal on the way back down. So what that basically means for us, if the market drops and we see a pullback that pauses mid-month, we'd be looking for another big downdraft to the downside up through the rest of September. The point of control for the January beans contract is at 894. So 894 would be the area that we'd be looking for key support, regardless of what the market does in the interim. So for now, 894 will be our key operating level for the Jan beans contract. As you can see from the movement here, it's done very well. We had our angle hold inside of here. The next test held very well. The market came in. We finally see a break of that level or of that angle. Upon breaking that angle, the market was able to gain some momentum to the downside. And currently, we're now tracing one of our angles, this green one, to the downside here. So we would not be surprised to see the market continue to trace all the way down and perhaps find support near that 900 or even the 910 number before really pausing or being able to stop. Our work on the wheat market was previously on the September contract. We've gone ahead and forwarded all that information or translated it over to the respective December contract. And what you'll notice here is the area that was our minimum price objective was not only met, but very well exceeded. The market came in, touched inside of that 415 area, and the market just simply collapsed. We're now sitting at about 390 to high 380s for this particular contract. And there's no real sign of strength or support really as of yet. In fact, the next major level of support that we're looking at is at 373. Upon reaching 373, the market will be oversold as it is right now already. But what we're looking at instead is for a continued downtrend movement and at best, perhaps a consolidation to the downside. So the weakness that we were looking for in wheat finally occurred. The catalyst that we're looking to happen to really hit the market and cause a move in either direction has come in, and now the market's really looking weak and not much is actually able to come in right now to indicate potential strength. It's going to be very important to really monitor the key support and resistance levels and to make adjustments as the market approaches those key support and resistance areas that we see for this contract. Every so often, we're able to share with you some of the techniques that we use to help us project future levels for contracts or future target levels for movements to happen. One of those techniques that we use is the notion of markets wanting to repeat ranges that they've done in the past. Here what we've done is we went back to the July high and we measured the range that was traveled on this contract all the way through to mid-February. That range came in at 165.25. Knowing that 165.25 is potentially an important range for this contract, we took this exact same measurement from the high in June, and then we went all the way back down and projected where a potential target could come in if we were to move again 165.25. That price level ends up at 386.25, and we're only a couple points shy of reaching that right now, with the low coming in at about 388 for this contract. And so our minimum price objective that we've had over the past few days for this contract was at 386.25. We're very close to hitting that right now. And these are some of the ways that we're able to see the rhythms that actually exist inside of the markets, in addition to using the price analysis tools to give us better means of being able to find complementary tools that all come together to give us a forecast as to where the markets may want to go. We'll close out again today with crude oil. As you can see from the low all the way up through the high, we have 13 bars from the low close to the recent high close. 13 bars, a 21% range movement, and 8.9 price range movement. What this tells us is a number of the Fibonacci series numbers coming in, really to foretell a potential top coming in. Once that top occurred, the market has since dropped. It has dropped into our window where we're looking for a potential change in trend, where either sometime this week or even into the middle of next week, we could see a reversal back to the upside for crude oil. Should it stop at support, either at around 46 and maybe even at around 43.35. If it breaks below 43.35, then something else is occurring, in that the market is then potentially even weaker than anticipated and may break to new lows. So we can monitor how he's moving from this point forward. But for now, again, we don't want to fight the tape. We want to simply trade whatever the market is offering over to us. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.